Hello everyone, and welcome to NeoSystems webinar on cash flow and financial preparedness. Our revenue is up, so why is our bank balance down? With me today, I have Sean Chen. Sean is one of our vice presidents of client services. He has over 18 years of experience in accounting and financial management roles with government contractors. He is responsible for delivering strategic financial management advice, as well as overseeing the day-to-day accounting operations for our clients. Also with me, I have Rich Wilkinson. Rich Wilkinson recently joined NeoSystems, and early in his career, he was a contracting officer in the Navy. He also served as a controller for several large government contractors. He's a recognized expert on compliance for government accounting. So please join me in welcoming Sean and Rich Wilkinson. My name is Brian Giblin. I do product management and marketing here at NeoSystems. And our webinar today on cash flow management and financial preparedness, it's in a series of webinars we're doing on positioning to win. Last month we did pricing to win, where we looked at pricing contracts so that you can win them and still be profitable, and how you can not only survive winning and growing your company, but how you can thrive in such an environment. After this webinar, we're going to take a month off for December. Hope you don't mind. And in January, we're going to look at, are you ready for CAS compliance? If you're pursuing cost-plus contracts, especially if you're doing that for the first time. If you can't wait till January and you want to give us a call, please feel free. We're also going to take a look at recruiting to win. A lot of opportunities today are almost like resume wars. So how can you find and retain the best talent? That's what we'll be looking at in that webinar. After that, well, now that you've hired all these people and you start to grow, you might be getting hit with a whole new batch of HR compliance requirements, and we'll be navigating those. So figuring out how you can do them, what your requirements are, and how you can best go about meeting those. And as your companies grow, we'll be looking at scaling your IT. IT might have started out as somebody's part-time job, but as you continue to grow and grow, it becomes a full-time position, and then with emerging technologies, how do you keep up and have somebody who's proficient in all of them? So we'll be taking a look at scaling your IT cost effectively for government contractors. After that, we're going to take a look at how could you leverage the cloud to meet your scaling growing requirements. And then at the end, we're going to take a look at, can we make the case for outsourcing some of these services? NeoSystems does accounting, IT, and HR services. So we'd like to make the case for outsourcing some of those services. And we'll leave it up to you to make that decision. Let's take a look at our agenda, though, for today. We're going to have some brief introductions, and I promise they will be brief. Then we're going to get into exactly what is cash flow, so we have a good baseline for us to move forward on. And then we're going to look at understanding cash flow forecasts. The idea that you can see what your cash needs are, not just today, but 30 days, 90 days, and even further out, so you can make the best decision. You know, we all know that if you had more time, you could make more informed, better decisions and navigate it. I kind of liken it to the Titanic. If it had seen that iceberg further back, it would have been a lot easier and a very, very different outcome. Then we're going to go on and look at some tips on managing your cash and managing your cash flow. And then, as always, we're going to open it up to your questions. If at any point during this webinar you have some questions, please feel free to type them into the question box on your screen. So looking at NeoSystems, we focus on nonprofits, government contractors, and any companies and organizations that are in high compliance industries. And we focus on the back office so you can focus on your mission. We let you deliver to your client, and we take care of all those compliance and regulatory issues for accounting and finance, for IT, and for human capital. And at NeoSystems, we're a Deltek Premier Partner, and we have the largest team of Deltek accounting system experts in the industry. We have currently over 500 companies hosted in our secure private cloud. And this really is over 40,000 employees doing their timesheets and otherwise using our Deltek products in the secure private cloud. I'm proud to say that NeoSystems has made the Inc. Honor Roll, Inc. 5000, 5 years in a row. And the other thing that we're really proud to say is not only has Neosystems made the Inc. 5000, but many of our clients have made it as well. And just recently, 3 of our clients were winners of the annual Greater Washington Government Contractors Award. So we're growing and our clients are growing, and we're very excited. At Neosystems, we're proud to say, grow ahead. We've got your back office. That's enough about us. Now I'd like to learn a little bit more about you before we dive into the webinar. So with that, we're going to open up a poll. So essentially, it's a simple question. Why did you join this webinar today? If we're going to talk about cash flow preparedness, are you cash is constrained right now and you need some help? Are you growing fast and starting to feel the cash strain? Or you just want more visibility into your forecasting? I'd like to just get a sense of where you are so we can better match our presentation to your current needs. I see the results coming in. So I'm going to give you about 5 more seconds. 4, 3, 2, 1. Close the poll. Share the results. Well, that's great, because fortunately, most of you just want more visibility into forecasting. So we're going to give you the tools and insights you need. And those of you who are growing or are cash constrained now, I think you're going to find some tips that are really going to be very helpful as well. So with that, I'm going to turn it over to Sean Chen. So if we could close the poll and move on to Sean.
Thank you, Brian, and thank you, everyone, for joining us today. Hopefully, you'll find some information in this webinar that will be useful to your organization or company. So we'll go ahead and dive right in. So what is cash flow? In this slide, you'll see that the cash in or inflow of cash and cash out, outflow of cash, are green for incoming receivables. And your cash in can be cash from credit card sales if your organization or company uses credit card processors. Your interest income, obviously the invoicing that you send out to your client or agency. Also rebates for any type of service or refunds from your tax returns. Your lines of credit, obviously, for those that have a line of credit, and other financing. And then, obviously, your outflow, or all of your expenditures, or your payment of services and other items, such as payroll, your benefits, all of your sub-Ks, consultants, rent, office expenses, asset purchases, and debt payments. And a lot of the common questions for multiple types of companies is, is my cash balance negative when my income statement shows profit? And throughout their presentation, we'll get into that, and a lot of the material applies to this common question. So a good thing to utilize in managing your cash and having the ability to forecast out when you're going to be positive in cash and when you're going to be negative in cash is to develop a spreadsheet or some type of forecasting model, so that you would have the ability to look at short and long-term demands within your organization or company. Also, forecasts alert you when you will potentially have a cash shortfall. And really having a tool like this will give you the ability to manage your business more effectively by making more sound decisions from a financial perspective. So best practices in developing and maintaining a cash flow forecast is to keep this as a working and living document, maintain your cash forecast on a regular basis. So, whether you use weekly, semi-monthly, monthly type forecasts, always maintain that. There will be always throughout the year, or even within a month, that you're going to have to spend money that would be unforeseen. So when you plug in those type of expenditures, you're able to strategize and manage your cash knowing that you have that large expenditure coming up within the next month or two. And always monitor your forecast, compare it to your bank balance, log into your line of credit bank website or your operating bank website, and just kind of always see what's hitting, what's coming in, and what's going out, and take those amounts and those trends and plug them into your cash flow forecast. So some of the cash flow methods that are utilized is projecting revenue and expenses, obviously. Revenue doesn't necessarily turn into sales, but a lot of times it does. So use your historical trends, know what your fixed price revenue or invoices are, project out when you'll have more work days within a particular month. Some months have holidays, some months have a lot more vacation taken than usual. Try to figure out what your sales or revenue would be based on the amount of work days within a particular month, and then take a conservative approach when projecting your cash inflow from your receivables. Something that we like to utilize here within Neosystems and our clients are figuring out to some degree how much of your receivables are paid within 30 days, 60 days, and 75 days plus. So in this example, you'll see that, as a sample, 65% of your AR receivables are paid within 30 days. Well, you can, that information is valuable when determining how much you need to pay and what your expected cash flow would be within that 30-day period. Some more methods that are continued. Take a less conservative approach for projecting cash flow out. And a good way of doing that would be, I always tell clients to take a really aggressive approach in all of your expenditures. So one thing that you can do is take your check registers on a monthly basis and review those, making sure that there's nothing that really kind of stands out that doesn't look right. Sometimes by going through a check register, you'll be able to see a vendor or an amount that you've never seen before. Check registers and check cutting and AP sometimes can become mundane, and if you don't review your check register on a monthly basis on regularly, you might miss something that shouldn't be there. So anyway, and another process that's good when reviewing the check register is that you'll be able to see all of your monthly expenditures and be able to plug in those monthly expenditures into your cash flow forecast. Obviously, review budgets and cost proposals to make sure that your indirect rates are kind of in line, and review your payroll and taxes. And as long as you have regular payroll and regular taxes, you can always plug in those items within your cash flow forecast, knowing that they will always hit at that particular time. Same thing with your office rent expenses and utilities. Always put in capitalized purchases if you are planning to make a fixed asset type purchase, and always include in your line of credit repayment. Obviously, if you're going to take out cash from your line of credit, you'll have to pay that back, so make sure you put that into your cash flow forecast as well. Okay, so we have two examples of cash flow forecast that we're going to show you all. One is a 30-day, and then the other one would be a monthly forecast. And this is a bit of an eye test, but in the meat of the slide, there are potential cash receipts from your contracts or clients to give you a potential cash collection within a 30-day window, and then same thing with your potential cash disbursements in a 30-day window. And then to the left, gathering all that information gives you really an ending cash balance that you can kind of understand where you're going to be at the end of that particular month. And then also in another example, we just put in a savings account, or if you have an investment account of some sort, you can always put some of your positive cash into that investment account or savings account so that you'll always have that ending cash balance as well. So in this sample forecast, we're showing you by month, and really the end game is to give you a closing cash balance that you can focus your day-to-day operations around and really understand when a good month is going to happen and when a bad month is going to happen, essentially. So at the top, you'll see that you'll have all of your contract sales or in cash inflows, and then on the bottom side, it's really your payments or your expenditures and outflows. So for instance, if under the salaries and wages, if you know that you're potentially going to win a contract, let's say in July or so, and it's 30 FTEs, you're able to plug in those 30 FTEs as salaries and wages, knowing that that's going to be an expense that the company has to take on. At the same time, typically when employees start for a new contract, they're going to work about a month or two before you see any type of return. So under your receipts or your inflow area, take that in consideration so that 60 days from the time the employee starts, 60 to 90 days is a pretty good range. You can also plug in those receivables from that particular contract so that once you're able to see a short-term picture of what your cash flow will look like, you can really focus around holding back expenses for a particular month or two because of some large expenses that are going to be going out of the company. Okay, so managing your cash. Now that you have a cash flow forecast developed and you're able to plug in the receivables and expenses within the company, you've essentially carved out a specific period in time in the future that you're hoping that your company will look like as from a cash perspective. So now, in order to manage to that particular forecast, you'll need to work backwards and know your key metrics or financial data. And the only way that your forecast will work is that if you have sound financial data, you have good finance and accounting people within your organization or company, and you have key metrics. And some of the key metrics that we utilize and for our clients we'll go through in a little bit. But these are some tips on managing your cash once you have a cash flow forecast developed. So be proactive in your collection process. Don't wait until day 31 to start calling or emailing your client. Control spending on a lot of your expenses, especially if your AR fluctuates from month to month. We have some clients that pay accounts payable or vendors right when they receive the invoice. Read the terms on the accounts payable, and if it's net 30, you don't have to pay that particular accounts payable right when you receive it. You can wait basically essentially 30 days until you can pay that. That'll free up some extra cash for other items that you need to expense out. Utilize your banking relationship. So if you have a line of credit, and I'm going to use the same example I did prior, where you have 30 FTEs that are coming aboard and you know that your line of credit currently won't support an extra 30 employees, utilizing your banking relationship will help with that transition. So talking with your bank, letting them know ahead of time that you could potentially have another 30 FTEs coming into the organization. How will the bank work for you? Will they be willing to extend and increase your line of credit without any more documents or processes? Knowing that information will help a great deal in those type of scenarios. Know your tax payment deadlines, such as your BPOL, your payroll taxes, your income taxes, your estimated taxes. A lot of times, I like to tell clients to be aggressive in their estimated tax payments and put that information into your cash flow so that when that time does come, and if you don't have to pay as much estimated taxes as you forecasted, that's great. That's an extra positive to you as an organization. That gives you more cash that you're able to do whatever you need to do with. And a big one is avoid penalties and fines. Really nothing drains your cash faster than penalties and fines and not paying things on time. So some of the metrics that we're going to show you directly impact your cash. So utilization is a huge metric for not only revenue figures, but also for cash. So higher utilization should lead to higher receivables. Higher utilization will definitely lead to higher revenues, but it's a good indicator prior to even invoicing on how well the month will look based on your employee utilization numbers. At the same time, if you see that your utilization numbers are lower than expected, it gives you an opportunity to go back to the employees or go back to the PMs and question why employees aren't charging to a particular contract or a client prior to invoicing. So if you could possibly change some of the direct versus indirect labor, that'll also help out. Another important metric is the DSO, which is day sales outstanding. What this ultimately does is that it gives you insight into the timing of collecting your cash. So if you start to see your DSO creep up and you have a target DSO, let's say 70 days, and you start to see it creep up, I mean, it could be a number of different variables included. One, it could be that timesheets aren't being completed, therefore completed on time, therefore invoicing isn't completed. Delayed invoicing is really the #1 cause of high DSO. Also could be that the invoices that are being sent out have a problem with it. So if you look into the IPP system or the old white area workflow system, I would check that regularly to see that the invoices that you've submitted have been approved, that they're moving along, and that there should be no holdup in your receivables. Also the same type, if you don't submit invoices electronically and you already know that the majority of your clients pay their invoices within a 30-day window, and day 28 or day 30 has come around and you still haven't received those, I mean those should be red flags to you to contact the client. And then really the third is just cash receipts have already been paid, have already come in for a particular receivable, and the finance person just hasn't applied it to DSO. So really there's a couple of different factors as to why DSO could creep up. But obviously if it's beginning to trend down, then you know that things are running smoothly, and the lower the DSO number gives you much more buying power or cash power. The other important metric is your revenue trend. Revenue trends should really correlate with the utilization metric that you utilize. Revenue trends are valuable because typically revenue should lead to receivables, and obviously receivables will lead to cash. So if you're beginning to see a downtick in your revenue, then you will eventually feel that downtick on your cash flow forecast. So there's always lag behind. So revenue is a really good indicator of how much cash you're going to be receiving within the following month or two. Another metrics, set of metrics that we use are your indirect rates. And why this is so important is that each month, hopefully you monitor your indirect rates. Hopefully you have a set of target rates that you begin with at the beginning of the year for your fringe, overhead, and G&A, and whatever indirect rates that you currently use. So having that particular target rate gives you already a set piece as far as being competitive when you go after RFPs. So whenever you see your indirect rates beginning to creep up, that means you're having more expenses within the company, but not increasing your direct base. Okay, so a good metric to utilize each month is your indirect rates and to see how much in line they are compared to your target rates or your budgeted rates. So anytime you have an increase in your overhead or your fringe or your G&A, that essentially means you're spending more money within the company. Okay, so again, monitor your indirect rates.
And boy, is it important to know what time of year you're talking about.
Right.
Because this happened to me once. We prepared a very detailed cash flow for a contract that's supposed to start in October. And like many October awards, there was a protest. It didn't actually get started until January. Well, we all know what happens to payroll taxes in January. Those cash expenditures for payroll taxes ballooned in January, and we had just assumed we could slip our cash flow forecast 90 days and everything would be fine. Everything was not fine. We drew down on that line of credit a lot more than we had hoped to have to because the fringe ballooned in January and February. And that's very predictable. Everybody knows it's going to happen, but we forget about it sometimes.
Right, absolutely. That's a great point. And I think that's why leveraging your banking relationship is so important. So for instances like that, where you know you can go to your bank, you have an unforeseen amount of expenditures for a particular time, and if you have a really good relationship with your bank and you have a line of credit, they might be able to help you step in and say, okay, we'll give you an over formula line. Here's $300,000 or so, and they'll develop terms to say, I need that paid back within 90 days. You're able to plug that into your forecast and say, okay, it's doable. We can definitely pay that over formula back within a particular span of time.
Yeah, one other thing too. Financial people, and I'm guilty of this as any of the rest of us, we try to be really precise sometimes. And cash flow is not one of those areas where you can be really precise.
Right.
So I agree completely with what you're saying about being very conservative with your cash inflow estimates and a lot less conservative with your outflow estimates.
That's correct.
Estimate on the high side. But then when you get through, add another 10 or 15 or 20% to your cash requirements and show that number to the banker.
Right.
Because these things just aren't very precise.
Right.
And a few days either way on a big receivable can make the difference in making a payroll or not.
Right. And a good way to be aggressive in your cash outflows are discretionary items, such as if you have a bonus pool within your organization, it's always good to be aggressive in that particular area. Same thing like we talked about earlier on the estimated taxes. If you know that you have estimated taxes at a particular time that you need to pay, be aggressive in that, because you can always scale back on those discretionary spending items, such as bonuses and estimated taxes. Okay, so for some cash flow tips on your AR, invoicing is always a priority within any organization, okay? So if you have a lot of fixed price invoices and they are set on a monthly level, set at a monthly amount each month, then you should be sending those invoices out the last day of the month or even before, so that you're going to collect on that cash pretty quickly, okay? Any other type of invoicing within the government contract arena, such as time and material and cost plus fixed fee, the most important piece of invoicing is getting your time cards in on time. A lot of the folks within an organization don't realize how important it is to get their timesheets completed by the end of the month on a particular due date. They just don't understand that how it really affects cash and invoicing. So the more time that that's delayed, the more time your invoicing will be delayed. Monitor your AR. Again, know which clients and agencies pay within 30 days, 60 days, and 70 days plus. If you have regular clients and agencies that are consistently late paying their invoice, monitor them. Keep them as a red flag. Contact them, always staying in constant communication with them. Contact them after 20 days, making sure that the invoice is correct if there's any problems. Contact them after another 10 days to see where the payment is within their payment process. And then always review your receivables prior to submitting them out to the client, making sure that you have more than one person reviewing those invoices. So for your accounts payable, use your vendor discounts. They might be a little bit here and there, but over the years, they really do add up. Develop purchasing policies within the company. So some small companies will have some executives that might have expense account or a credit card account. And if you don't have any purchasing policies in place, for PMs, they might think that they need to spend money on an item within the company, and really there isn't an approval process on that. So you could essentially be seeing money going out of the company without really kind of any approval, and when you develop your cash flow forecast, you won't have any insight into what's being purchased by other members of the company. So developing a purchasing policy will really prevent that. And then on the same, on top of that, and piggybacking off of purchasing policy, utilize company credit cards so that when an expense is made through a company credit card, not only are you able to see the backup for that particular purchase, but if you utilize a purchasing policy, you can marry up the policy along with the credit card statement to make sure that both expenses are in line. And really a good process and procedure to utilize with company credit cards is have the employees liable for the credit card themselves. That way it really kind of gives the liability on the credit cards on your employees rather than the company. So they're less likely to spend items that aren't authorized. And most important is avoid factoring at all costs. So for those that don't know what factoring is, let's say I'm the factoring company and you're my client. You need cash right away to pay for either subs or other expenses, or most commonly expenses used for factoring is payroll. So you give me an invoice for $100,000. I review the invoice, make sure that it's a valid invoice. I contact your contracting officer to ensure that all the costs within this invoice are valid. And then I say, okay, well, I'll give you $90,000 right up front. I'll keep $8,000, and when you get paid for the invoice, I'll give you an extra $2,000. So essentially, I'm giving you $90,000, but I'm keeping $8,000. So if you're most of the time, companies that use factoring are already kind of spiraling out of control, and factoring just speeds up that process. So if you as a company or organization are already into factoring and you need help to get out of that, because once you're in that particular cycle, it's very difficult to get out of because you're so used to that cash, that liquid cash coming into your pocket right away. And as our organization, we can help you get out of that factoring spiral. So cash is king. That's an old adage that it still applies to this day and age. Really have good, trusted financial advisors within your organization or outside of your organization. Good, trusted financial advisors give business owners a lot of insight and communication that normally they wouldn't have. Good financial advisors can come up with creative and innovative ways to strategize going forward for your organization or company. They can minimize financial obstacles and roadblocks that you may encounter. And they're really the baseline for solid financial decisions retroactively and proactively. So managing cash flow successfully will obviously have an impact on how your business grows. As your business grows and as you're able to manage your cash, hopefully you'll have enough cash where you are positive month in and month out. When you become cash positive for a particular period of time, that gives you more cash to make more investments within your company, okay? So that's really how you want to handle excess cash, is that you want to reinvest that money back into your company. So for employees, like we talked about bonuses, hey, all of your employees are hard workers. They are the ones that are driving the positive cash flow. Bring it back into them. Give them some bonuses. Give them some, some type of incentive, and that's an investment back into the company. Upgrade your infrastructure within the company. You have positive cash flow. Hey, you're going after a lot of RFPs. You need to hire a proposal manager. Hire a proposal manager. That'll invest back into the infrastructure. Invest back into technology. Get to the latest and greatest technology for within your company. And then as you begin to grow and your money begins to grow as well, invest in new business markets or new verticals. Using this as an example, if you want to go into the medical field, invest in some SMEs, invest in a business development employee that can penetrate that particular new market. So really the impact of managing your cash flow successfully will improve employee morale because employees will be able to see the difference. I mean, everyone knows, I'm sure everyone has worked in a company where cash has been a very difficult thing, and it's always on someone's mind within that organization. If cash is difficult, hey, when are we going to go under? Are we going to be able to make payroll this time? So having positive cash really improves that side. Also, it strengthens vendor relationships. So vendors are more likely to give you a higher line of credit if you desire that to do so, because you have such a good track record in paying that particular vendor on time. And obviously, it creates less financial stress for everyone within the organization or company. So that's going to do it for our content, and I'll go ahead and turn it over to Brian Giblin for our second poll again, and then I'll come back on to answer questions.
Thanks, Sean, and thanks, Rich, for your other comments, and we'll be getting to your questions in just a moment. But first, I have a poll question for you. How does low cash flow impact you? And I guess you have to pick the one that is the highest for you. So, is it juggling vendor payments, or are you struggling to get invoices out on time, so the government might be a little slow in paying you? If the invoices aren't getting to them, they're not going to get the money back to you. And also, is it in giving you purchasing constraints? Sean talked about taking advantage of vendors' terms. A 2% discount or 1% discount might not seem like much, but they add up over time. And if you can't take advantage of that, or either other volume purchases, and you're just paying what you can get away with the minimum amount, it ends up costing you in the long run. Or maybe you're one of the lucky few who doesn't, you don't have a cash flow problem in the world. You're just rolling in cash. That is, that is a lucky situation, and I hope oh yes, some of you are in that situation, so that is great. So we're going to close the poll here in a couple of seconds. So, and I know every time I start my countdown, I get a couple in. So 5, 4, 3, 2, 1. Close the poll. Let's share these results with everyone. Okay. So good results. The most popular is that people struggling to get those invoices out on time. That is a real challenge, and here at Neosystems, they're certainly familiar with that. And as Sean alluded to, some of the things people do, making sure you get those invoices that are predictable monthly invoices out prepared in advance, so you can send them out on the last day of the month or the first day of the month. Bang, get those out the door, or just putting everything out on getting your timesheets done for those cost plus ones. I just heard from one of our clients. He was going through what they do to get their timesheets on. They're very, very serious about timesheets. They have, if you're late 3 times getting your timesheet in, you're in his office, the CFO's office, and if I forget the number, whether it was 5 or 6 times you're late, you're sitting in his office with the lawyer. So they are very serious about timesheets and getting those in on time. I see some of you are rolling in cash. Send me an email. Maybe we'll get together and you can buy me a drink on how you're doing that. I'd love to hear your stories.
Brian, I want to know who those people are, because in my experience, they're not government contractors.
Oh, okay. So, so forgive us for having a little fun with that one, but excellent results. Thanks for sharing that. I think, but the good thing is, well, not the good thing, but what I think everyone can take away from this is a lot of us share these same challenges, and that's important to realize that this isn't unique to your company, especially in these days with LPTA for the government and lower margins. Cash flow becomes harder. If the lower margin is there, you're juggling your costs, and then you have your unallowable costs of your interest and such. It can become particularly challenging. So with that, just want to also point out to you, you have some other resources available to you. Oh, by the way, if you want to start typing in your questions now, that is perfectly fine. While I mention some of the other resources to help you answer your questions. We do have the webinar series that we're putting on now. We also have courses in person and online that are available from Neosystems. Our blog, we blog on a lot of topics. Sean has blogged on various accounting issues and cash flow. I actually blog on things like credit cards, so if you're interested in, the government does pay with credit cards, or actually their purchase cards. But we blog on a lot of different issues, and some of them might help to answer your questions. We have our newsletter, we have our industry events, and at any time if you have a question, please feel free to email to growahead@neosystemscorp.com. And I just do want to recap about the upcoming webinars. If you're looking at doing it, if you're looking at CAS compliance, you're going to pursue your first cost plus contract, you have questions. That webinar, we're going to be putting that one on in January. But again, if you have questions now and you want to get some help or advice, please feel free to reach out to us. We're happy to at least have a conversation on the phone, if nothing else, and talk about some of your issues and challenges with that. And with that, I want to open it up to your questions. And always, one of the questions we get is, will this webinar be available? And yep, we get that question, and we will make the recording of this video available. And what, other questions I was seeing up there, people talk about that banking relationship, and how do you go about developing it? Can Rich and Sean, can you speak more to how one can best go about developing their relationship or talking to their bank about challenges and issues? Or is it about how you present the information, or is it the bank you pick?
It's all of the above, Brian. It's the bank you pick. It's how you maintain that relationship. It's how you begin that relationship. But you know what? The key to keeping a banker interested in what you're doing is the same as keeping a customer interested in the service you provide. Stay in their face. Literally. Talk to them every week about something. If you have to make something up to call them about, call them. Talk to them. Go sit down with them.
Yeah. Right. Yeah, and keep in mind that if you're a small government contractor, especially, and you're in an area that there are a lot of government contractors, there are a lot of small banks, small to mid-sized banks that will work with you that can see the potential in your company, okay? So even though your balance sheet and how it looks, especially tangible net worth, how that looks is the determining factor for all banks, regardless of size, okay? But if you're able to give forecasts out, not only just cash flow forecasts, but also revenue forecasts, pipeline information to the bank, and be able to tell a good story. That's key here, is that you're able to tell a good story, but basically saying, my balance sheet stinks right now, but I've got really good people that are involved in the organization. We have this opportunity that's going to hit within the next 3 months. I'm 90% sure that I have a 10 FTE contract that's going to be hitting within the next month. Here's what my profit's going to look like. Here's what my revenue is going to look like, and here's what my forecasted tangible net worth will be. Most small banks will work with you, okay? Now, if you go through a Bank of America with that type of information, or a BB&T, they will treat you like a number, okay? And essentially, you're going to be too small. So we always tell people, we always tell really small to mid-sized type government contractors, specific banks that we've worked with, that we've partnered with, that we feel that can help them, especially going from no for a company with no or one contract to multiple.
And so one of the, Sean, to build on that, and a couple of people have chimed in with questions about, like, could you recommend a bank? And I think we'd rather not just recommend specific bank names over the air here. But if you have questions on that, we would be happy to follow up. So if you're interested in specific bank recommendations, please add to that question, and we will build on that. One other question. Oh, Sean, you wanted to add something there?
So one question we have, or what are the other options for other than factoring to get cash advances when you need? So there are other options. They're not called factoring, okay? So you can find companies, really organizations, or even bank-related type organizations that will give you payroll, all right? That will upfront payroll, but they act kind of like a factoring company. The thing with factoring is that if you absolutely need it and you don't have any other choice, other than some of the things that we had discussed where you can tell a story to a particular bank, if you absolutely have to go to factoring, shop around. Shop around to the different ones, because each one has a floor, each one has specific rates and specific guidelines. So find one that really kind of works with you and gives you the best type of rates.
Yeah. So if you're already in that situation and you need the cash now, okay, then you need to look at, okay, what are the terms? What is this really going to cost me at the end of the day? Are there other tips you guys have for maybe what could you do well in advance of that, either in terms of payment terms with the government or payment terms to your subcontractors? Do you have any suggestions there for people, things you can do before you get into that crisis mode?
I remember when I was with the company and worked with a subcontractor that was on a contract that we had, and he just reached out and said, "Look, I'm a really small business. I know that I'm supposed to get paid when you all get paid, but I have 10 employees, and I really need the money to come in. So can we work out a deal where I get paid prior to you all get paid on this particular contract?" We looked at the contract. We looked at how quickly we were getting paid for this particular contract, and it ended up that we were able to basically give him his payment prior to us as the prime getting our payment in. So I think like Richard said earlier, get in front of people, have face-to-face, have a lot of communication, and people will be amazed at how much can be resolved through communication.
So the sub, you want to say, hey, I get paid under these terms, regardless of whether you get paid. You want to try to negotiate for that. As a prime, you probably want to negotiate with your subs, hey, you get paid when I get paid.
Right.
Or paid when I get paid plus 10, things like that. Rich?
If you're a subcontractor going into a teaming agreement on a big opportunity, the time to negotiate those payment terms is when you're writing the proposal, not after you win. After you win, you're on the team, you're part of the job, but your leverage is gone. The time the prime needs you is to help the prime win. So they need you on the team, they need your resumes, they need your past performance, they need your expertise, they need your help writing the proposal. After they've won, all they need you to do is do the work. Your leverage on negotiating terms is very poor even after the proposal is submitted.
Right.
So the time to negotiate stuff like that is before that proposal goes in.
Right.
Another thing, one of the things that small companies can do, and there's work associated with this, but it's worth it, is accelerate your invoicing. Small companies can invoice twice a month if they want to. And half a month's interest on your entire receivables for a year is a chunk of change.
Mm-hmm.
And just getting the money 2 weeks earlier, it can make all the difference in the world.
Right.
I've done it on some very large contracts, and we frankly didn't do it on all contracts. We only did it on the big ones where it was really worth it.
Right.
If you invoice twice a month on a really small job, you just work yourself to death.
Right. Yep. Absolutely.
Good balance between those two. Yeah, if it's a small job, why bother? Because it's just extra work. But if it's a large contract, then it is worth doing. And plus, that way, if there's a problem with the invoice, you're going to know it sooner.
Well, there's another reason. Now, if you're a subcontractor, it's pretty much a waste of time because the sub's going to just hold your invoice until they invoice the end of the month and wrap them together. But if you're the prime, it's easier to get multiple small invoices past the COTAR than it is one big invoice at the end of the month. So if you're putting something in front of that COTAR every 2 weeks or twice a month, it's easier to get that process established and get that flow, keep that flow going, than it is if they just see one invoice at the end of the month.
Yep. Okay, and then there's some other questions in here that aren't really questions, but statements or other things that really can't answer live. So please feel free to email either myself, Rich, or Brian, and we can answer those emails on a more personal level. And then there's one other question in here about credit card potentials with government contractors. Brian, did you want to go ahead and go
Sure,
into that?
I can answer that one, Sean. Yeah, the government has their Smart Pay program where they they have purchase cards, and they make about $15 to $20 billion a year in purchases. And the interesting thing about these cards is that for small purchases under $3,000, the purchase card, it is the contract vehicle, the commitment vehicle, and the payment vehicle all in one. And you'll get your cash in 1 to 2 days deposited in your bank. So definitely a great way to accelerate cash flow. And even for amounts above the $3,000, if you have a contract in place, such as a GSA schedule, then the credit card or purchase card from the government is the commitment vehicle and the payment vehicle. So no purchase order is required. The contracting officer can just make the commitment with the purchase card. So that is another way to help you to get sales and to accelerate cash and payment from the government. And it's in the government's interest too, because I can and have spent a whole session on credit cards, and probably will do it again soon. But yeah, the government actually gets money back on these as well. So it's in everybody's interest. Everybody wins. But I know a lot of people are reluctant to accept credit cards because of the transaction fees. But if they're done right, you can actually minimize that transaction fee and make it so that it's at a tolerable level for accepting payment. And when you look at the speed of payment, it's compelling. So with that, I want to thank everybody for joining us today, and I look forward to seeing you all again with our next in this series. This series has been focusing on positioning you to win. What is it going to take to help you win that big contract? What are you going to do during that win to position yourself to succeed and thrive afterwards? And then afterwards, what are the things that you can do that will help you to grow your company and succeed as a larger government contractor? So once again, on behalf of Sean and Rich and all of us at Neosystems, thank you for joining us today. Have a good afternoon.